Summer likes to think the best of people and assumes they will pay her back. But reality can sometimes be a splash of cold water. Because of that, we have accounts uncollectible and a process for recognizing money that won't come in. When a customer or vendor pays for something on credit, that amount is logged under accounts receivable. Over time, 30 days for example, if the customer fails to pay, this money moves to an aged receivable account. Then, if even more time passes with no payment, the money moves to a doubtful account, and then finally, an accounts uncollectible. This is logged as a bad debt expense on the income statement, and of course will reduce your profits. Let's say Summer and Sophia sold $5,000 worth of massage oils to many customers. Of that $5,000 in sales, $1,000 was sold on credit to the store Nature's Bounty. Nature's Bounty declares bankruptcy, and it is uncertain if they will be able to pay the $1,000. Summer and Sophia show $5,000 in accounts receivable, but now also $1,000 in allowance for doubtful accounts, which would be $4,000 in net accounts receivable. Over time, it's determined that Nature's Bounty had creditors in line and received all assets as priority lenders. Because of this, Summer and Sophia will not be receiving the $1,000. Summer and Sophia now have to write off the amount as a bad debt expense on their income statement and reduce the allowance for doubtful accounts by $1,000. Got it? Good. Just in case, though, here's an expert with some advice.
One thing that if you find that you have uncollectible accounts, then you might figure out that you've got to, as a business owner, you might figure out that you've got to be more proactive and perhaps even aggressive in getting your money, because the longer it takes for somebody to pay you, as time goes on, the odds that they're going to pay you drop and drop and drop. So it might allow the business to say, hey, we've had a lot of bad debts from these uncollectible accounts. Let's either raise our prices, or if it's clients of a certain type, we'll ask for money up front, or we're going to change our terms or something like that. So when you've got that going with uncollectible accounts, yes, it's definitely a hit to the bottom line, but that means that the business decision makers have to pivot and not continue doing what they were doing. What do new bookkeepers need to know about working with uncollectible accounts? Well, certainly they need to know how to book those uncollectible accounts so that they no longer appear in accounts receivable. So they have to know how to write off or write down these invoices, whether they're going to use the accountant tools with the write-off invoices tool, or if they're going to create a credit memo for either to bad debt or to the original revenue accounts. And if there's any sales taxes involved, then they should definitely use the credit memo approach, because that way you can include the sales taxes. So if you thought you were collecting $50 in for sales taxes, you don't want to have to remit that to the various governmental bodies if you're not actually getting that from your clients. So you want to recoup that by doing a credit memo to bad debt or to whatever revenue, and make sure that you hit the same sales tax codes so that it reduces the sales tax that you owe to those governing bodies.